RAVE fell from about $28 to nearly $1 in a day, and the real damage came from liquidity vanishing before most holders could exit. The pressure point is simple. A 95% wipeout exposed how fast a hot chart breaks when liquidity disappears. RAVE Token Crash is the search phrase, but the immediate question is where the next break or failure actually sits. The tension here is simple. The loudest claim is not always the part with the strongest proof. The token dropped more than 95% in roughly 24 hours, erasing about $6.3 billion in market value after a near-vertical run that had pulled in traders chasing momentum. The chart move is dramatic, but the deeper issue is whether the market underneath it was ever broad enough to support ordinary exits. That gives the story a hard anchor before sentiment starts doing the storytelling. Wallet data highlighted by on-chain investigator ZachXBT showed addresses linked to the deployer moving large amounts of RAVE onto exchanges near the top, which intensified suspicion that insiders were preparing an exit. In easy English, concentrated supply means too much control sits with too few wallets, so price can move without broad demand. This is where structure matters more than surface excitement. For people typing RAVE Token Crash, the next useful step is to separate what is already operating from what is only being promised. Critics also focused on token concentration and listing standards, arguing that when a handful of wallets control most supply and no meaningful vesting exists, the listing itself can become the dump. That detail is often where the risk moves from theory into actual exposure. The mechanism here is brutal and familiar. Concentrated supply plus thin liquidity means price looks strong until enough holders rush for the door, and then the order book can no longer absorb normal sell pressure without extreme slippage. For traders searching, KW, the important distinction is between a bounce created by mechanics and a recovery supported by healthier ownership and liquidity. Once that mechanism is visible, the pricing story gets easier to read. For retail holders, that means the price screen can lie. A token may show a large notional market cap, but if there are not enough natural buyers on the other side, the exit price available to real people can collapse far faster than the chart suggests. When slippage gets extreme, a token can keep showing a price, while many holders can no longer access anything close to that price size for size. This is why users, traders, and treasury desks can react very differently to the same headline. What is still unclear is how much of the move was deliberate insider distribution versus opportunistic speculative unwinding after a hyperbolic rally. The exchange flows raise real questions, but they do not settle every theory on their own. The next signal is whether any bounce comes with deep spot liquidity and cleaner ownership data, or whether it turns into another reflex move fueled mainly by short covering and bottom fishing. The uncertainty is part of the valuation, not a side note after it. That is why RAVE Token Crash ends with one hard test: whether the next move comes with healthier liquidity and cleaner structure than the last one. When a token breaks this way, the chart is only the surface. The real question is whether the market structure beneath it ever deserved the confidence it was given. Once the noise is stripped away, follow-through is the only thing that can confirm the pitch.